What will give you the conviction to go in there and say, this is it, this is the washout, we can start to buy?
Lisa, I think the issue is we have three things happening at the same time. There's this growth conundrum with investors trying to figure out which is the most likely path from here. Is it a soft landing? Is it a recession? Is it stagflation? But you add on to that a correction of the excesses that we've built up over the last 4 years, and amplified by a third factor, which is very low liquidity in both equities and fixed income markets. So I think at the moment we've seen a big correction in valuations. We've seen nearly a 20% contraction in the multiple, with the S&P 500 now trading at average valuations. But you still have very low conviction from investors to really truly believe this is the end, because you still have all of these uncertainties. So what do we need to see? I think you especially need a bigger conviction on that growth scenario front. So you do need to see peak in housing costs. You need to see peak sanctions towards Russia to feel more comfortable about commodity prices. And you need to see peak lockdowns in China to feel more comfortable about the growth outlook there.
Gabriela, you talked about liquidity concerns, the fact that there is such little liquidity. You talked about the froth in markets that's gotten beaten out by the readjustment in valuations. Are you starting to worry about financial market conditions, about the functioning of the basic nuts and bolts of how things trade and sell?
So in terms of financial conditions, we have definitely seen a tightening in those ultra loose conditions that we had at the beginning of the year. You now have the tightest financial conditions that we had since 2018, but still pretty loose and just approaching neutral levels. So we're not quite concerned about tight financial conditions quite yet. In terms of the actual functioning of the markets, I think at the moment that is not a reason for concern or a need for the Federal Reserve or other regulators to step in. It's just something that amplifies any of the moves that we see driven by the macro stories, and something that causes more risk aversion and a hesitancy to step in from investors.
Well, in your base case is still the Fed being able to execute that soft landing on that very, very narrow landing strip that John and Lisa were just talking about. With each day that passes, how much risk grows around that idea?
So I think you invest based on your base case, which for us is a soft landing, but you diversify the other routes just in case, the recession and stagflation scenarios. So in terms of the investing based on the soft landing, we would still advocate for having a small overweight to stocks, a small underweight to duration, a balance between growth and value. But you want to still be diversifying the other scenarios. So to diversify the recession scenario, it's a small underweight to duration versus a big one at the beginning of the year. It's overlaying a quality factor on top of any of the stocks that we're thinking about investing. And in terms of diversifying the stagflation scenario, it means bringing the prime candidate for stagflation, Europe, down more to a neutral. It's focusing on commodity exporting regions like Canada. And it's focusing on diversifiers like real assets that do well when inflation is the concern.
Well, while we're talking about regional diversification, you mentioned Europe and Canada there. Let's talk about China, which you mentioned at the beginning. Investors kind of need to see something changed with COVID zero policy. But it's not just that. You also have a serious crisis in the property sector. Sunak defaulted today because it didn't make its payment on a dollar bond coupon after that grace period expired. How are you thinking about China right now, and where you would find an entry point in that market in particular?
So I think emerging markets in China are also dealing with this trifecta of issues that we mentioned. In China, you had a correction of the excesses that already happened last year. That was a market that February 2021 was one standard deviation expensive. Now it's nearly one standard deviation cheap. You also have a growth scare happening at the same time, driven by some of those structural slowdowns in the economy, namely property and low-end manufacturing, as well as the pandemic. So I think for investors, the correction of the valuation excesses is already there in China. Now you need to get a bit more comfortable on the growth picture. And for that, really, I'm looking for three things. The first is a redefinition of success when it comes to COVID zero. So it doesn't mean abandoning the policy, which is very tough to do. It's just redefining success, lowering the threshold for reopening. We also want to see that the policy put is still in place in China. So we want to see a little bit more monetary stimulus, maybe a cut in the loan prime rate this month. And lastly, we want to just see silence and regulations for investors
Stop talking.
to get a bit more comfortable that we're past the worst. And there's an important innovation meeting next week, and it would be just welcome news to not see anything new come out of that.